Welcome, ladies and gentlemen, to Boss Economics World, the only show that takes the dismal science of economics and turns it into a roller coaster of satire, sass, and straight-up truth bombs. I'm your host, the one, the only, boss economist extraordinaire, here to break down the latest economic drama with the finesse of a Wall Street trader and the skepticism of a conspiracy theorist who just found out the Fed prints money. Buckle up, because today, we're diving headfirst into the Federal Reserve's latest circus act, starring Jerome, steady hands, Powell, a double descent straight out of a Hollywood blockbuster, and a White House that's yelling, cut rates, louder than a toddler demanding candy at a grocery store checkout. Now, if you've been following the financial headlines, or, let's be real, doom-scrolling X, formerly Twitter, for the latest economic hot takes, you've probably heard about the Fed's July 2025 meeting. For the fifth time in a row, the Federal Open Market Committee, FOMC, decided to keep interest rates steady, prompting the first double descent from Fed governors in over 30 years. That's right, folks, we've got drama in the Fed boardroom, and it's juicier than a reality TV reunion special. But behind the headlines lies a web of economic issues so tangled, it makes your grandma's knitting look like a straight line. So, let's unpack this mess, layer by layer, from the surface-level shenanigans to the deep, dark underbelly of global economic chaos. And, as always, we'll do it with data, examples, and a healthy dose of satire to keep you awake through the jargon. Let's start with the obvious. Jerome Powell is playing the world's most high-stakes game of wait and see. The Fed decided to hold interest rates steady, shrugging off pressure from the White House and ignoring the pleas of two dissenting Fed governors who were practically begging for a rate cut. Powell's reasoning: inflation risks are still lurking in the shadows, and the economic fallout from Trump's tariff tantrums is as unpredictable as a reality TV star's next tweet. In his press conference, Powell basically said, look, we've got 2 months of employment and inflation data coming up before our September 2025 meeting, so let's just chill, okay? Now, for the average Joe and Jane watching this at home, this might sound like a reasonable, level-headed approach. But let's be real, this is the Fed we're talking about, not your local book club deciding whether to read Pride and Prejudice or Twilight. The stakes are sky high, and Powell's neutral stance sent shockwaves through the markets. Investors, who were practically salivating at the thought of a September rate cut, threw a collective tantrum, selling off U.S. Treasuries, pushing the dollar to its highest level since May 2025, and sending the S&P 500 into a tailspin. Interest rate futures markets slashed the probability of a September rate cut from 60% to 40% faster than you can say, quantitative easing. But here's the kicker, folks, Powell's wait-and-see approach isn't just about caution, it's a masterclass in dodging accountability. By refusing to commit to a rate cut or a rate hike, Powell is keeping his options open while the rest of us are left scratching our heads, wondering if the economy is a ticking time bomb or a golden goose. And let's not forget, this isn't just about numbers on a spreadsheet, this is about real people, real businesses, and real livelihoods hanging in the balance. Now, let's peel back the first layer of this economic onion and talk about the Fed's obsession with inflation. Powell made it crystal clear in his press conference that the Fed is more worried about inflation than a germaphobe in a crowded subway. He even said, and I quote, a reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level, but it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Translation: we're scared inflation might stick around like that one guest at a party who just won't take the hint to leave. But is this fear justified, or is the Fed just crying wolf? Let's look at the data. According to the latest consumer inflation data for June 2025, companies are starting to pass on tariff-related costs to consumers, pushing up prices in a way we haven't seen since the early days of the post-COVID recovery. The Consumer Price Index, CPI, rose by 3.2% year-over-year in June 2025, well above the Fed's sacred 2% target. Core inflation, which strips out volatile food and energy prices, was even stickier at 3.5%. And if you think that's bad, take a look at producer price inflation, PPI, which jumped by 4.1% year-over-year, signaling that businesses are feeling the heat and passing it on to you, the consumer. Now, here's where it gets spicy. A big chunk of this inflationary pressure is coming from, you guessed it, Trump's tariff wars. The Trump administration has slapped new tariffs on dozens of U.S. trading partners, with deadlines looming as early as August 1, 2025. Sure, they've struck deals with Japan and the EU, but the uncertainty is still thicker than a New York cheesecake. Powell himself admitted that the Fed is still a ways away from seeing where things settle down, which is Fed speak for, we have no idea what's going to happen, but we're crossing our fingers and hoping for the best. But here's the satire-worthy part. While the Fed is busy wringing its hands over inflation, the average American is out here paying $5 for a loaf of bread and $7 for a gallon of gas, wondering if they'll ever be able to afford a vacation again. And let's not forget the businesses, small and large, that are getting squeezed by higher input costs, tighter margins, and a consumer base that's starting to tighten its belt. So, while Powell is busy assessing and managing risks, the rest of us are just trying to survive the inflation apocalypse. Now, let's dig a little deeper into the second layer of this economic mess, the labor market. This is where the Fed's double dissent comes into play, and boy, is it a doozy. Governors Christopher Waller and Michelle Bowman, both Trump appointees, mind you, broke ranks with Powell and voted for an immediate rate cut, citing fragility in the labor market. Waller pointed to slowing private sector payrolls, while Bowman highlighted downside risks that could derail the Fed's goal of maximum employment. So, what's the deal? Is the labor market really on the brink of collapse, or are Waller and Bowman just trying to score political points with their boss in the White House? Let's look at the numbers. According to the latest Bureau of Labor Statistics, BLS, data, the U.S. added just 150,000 jobs in June 2025, well below the 200,000 average monthly gain we saw in 2024. The unemployment rate ticked up to 4.2%, and wage growth slowed to 3.1% year-over-year, barely keeping pace with inflation. Meanwhile, job openings have fallen to their lowest level since early 2021, and the labor force participation rate is stuck at 62.5%, meaning millions of workers are still sitting on the sidelines. But here's the kicker, Powell isn't buying the doom and gloom narrative. In his press conference, he described the labor market as solid, and said the Fed is closer to its maximum employment goal than its 2% inflation target. Translation. Sorry, Waller and Bowman, but we're not cutting rates just because a few people can't find jobs. And here's where the satire comes in. While Powell is busy patting himself on the back for a solid labor market, the average worker is out here juggling 2-gig jobs, praying their car doesn't break down, and wondering if they'll ever be able to retire. Meanwhile, corporate America is raking in record profits. S&P 500 companies reported a 12% increase in earnings in Q2 2025, while wages stagnate and layoffs loom on the horizon. Ah, the American dream, folks, where the rich get richer, and the rest of us get a participation trophy. Now, let's peel back the final layer of this economic onion and talk about the elephant in the room, Trump's tariff wars. If you thought inflation and labor market woes were bad, buckle up, because this is where things get really messy. Trump's tariffs have injected so much uncertainty into the global economy that even the Fed, usually the master of calm, cool, and collected, is starting to sweat. Powell admitted as much in his press conference, saying, "It doesn't feel like we're very close to the end of that process." Translation. We're flying blind, folks, and we're just hoping the plane doesn't crash. Let's break this down with some hard data. According to a 2025 report from the Peterson Institute for International Economics, Trump's tariffs have already cost U.S. consumers an estimated $50 billion annually in higher prices, with the average household paying an extra $1,200 per year. And that's before the latest round of tariffs kicks in on August 1, 2025. Meanwhile, the International Monetary Fund, IMF, has warned that escalating trade tensions could shave 0.5% off global GDP by 2026, with the US and China bearing the brunt of the damage. And let's not forget the ripple effects, supply chain disruptions, higher input costs, and a potential slowdown in global trade that could make the post-COVID recovery look like a walk in the park. But here's the satire-worthy part. While Trump is busy touting his tariffs as a win for American workers, the reality is a lot messier. Take the steel industry, for example. Sure, U.S. steel producers have seen a boost. U.S. steel stock is up 25% since the tariffs were announced, but at what cost? Downstream industries, like auto manufacturing and construction, are getting hammered by higher input costs, with Ford and General Motors reporting combined losses of $1.5 billion due to tariff-related expenses. And let's not forget the farmers. Soybean exports to China have plummeted by 40% since the trade war began, leaving rural America in a state of economic despair. So, while Trump is busy slapping tariffs on everything from aluminum to avocados, the rest of us are left wondering if we'll ever be able to afford guacamole again. So, what does all this mean, folks? At its core, the Fed's latest decision, and the drama surrounding it, reflects a central bank caught in the crossfire of competing economic forces. On one hand, you've got inflation risks, fueled by tariffs, supply chain disruptions, and a consumer base that's starting to feel the pinch. On the other hand, you've got a labor market that's showing signs of weakness, with dissenting Fed governors warning of a potential downturn. And in the middle, you've got Jerome Powell, trying to balance these risks while fending off political pressure from a White House that's more interested in short-term wins than long-term stability. But here's the real question, folks, is the Fed's wait-and-see approach the right move, or is it just kicking the can down the road? If inflation continues to rise, and the latest data suggests it will, the Fed may have no choice but to tighten policy, potentially triggering a recession. But if the labor market weakens further, and the dissenting governors are right, the Fed's inaction could lead to a wave of layoffs, bankruptcies, and economic pain. Either way, the stakes are sky high, and the margin for error is razor thin. So, there you have it, folks, the Fed's latest circus act, dissected, satirized, and served up with a side of data-driven truth. Whether you're an ordinary Joe worried about your grocery bill or a finance pro trying to navigate the markets, one thing is clear, the economy is a mess, and the Fed is stuck between a rock and a hard place. But hey, at least we've got Boss Economics World to make sense of it all, right? Until next time, keep your wallets close, your skepticism closer, and remember, in the world of economics, the only thing certain is uncertainty. This is your boss economist extraordinaire, signing off.